Most people think they lose money because they don't know enough. The truth is far more uncomfortable. You can understand every chart, read every report, follow every expert, and still destroy your wealth. Because the real enemy is not the market. It's your brain. Every panic sell, every greedy overtrade, every "this time is different" decision is driven by ancient survival wiring that was never designed to handle money, risk, or uncertainty. Your brain is built to run from danger, not to build wealth. It confuses volatility with threat, temporary losses with permanent failure, and noise with meaning. Inside your head, fear feels like intelligence. Overconfidence feels like skill, and emotion disguises itself as logic. This book exposes the hidden mental traps that quietly drain portfolios, sabotage long-term thinking, and keep intelligent people financially stuck, not because they're reckless, but because they're human. Once you understand how your brain lies to you about money, you stop reacting. You stop panicking, and you finally start investing like a professional, not emotionally, but intentionally. This is not a book about beating the market. It's a book about beating yourself, because that's where every real financial battle is won or lost. Chapter 1. Inside the Investor's Brain: The Power of Mind Over Money. Why smart people make bad financial decisions. Before money is lost in the market, it is lost in the mind. Inside the Investor's Brain: The Power of Mind Over Money begins with a brutal truth. Most financial mistakes are not caused by lack of knowledge, but by the way the human brain is wired. The market does not defeat investors. Their own psychology does. Chapter 1 pulls back the curtain on a dangerous illusion, the belief that intelligence, education, or experience alone can protect you from bad decisions. The book explains that even highly intelligent, well-informed investors repeatedly make irrational choices, not because they are careless, but because the brain uses emotional shortcuts when money is involved. The human brain evolved for survival, not investing. Thousands of years ago, reacting quickly to danger meant staying alive. Today, that same wiring causes investors to panic during market drops, chase rising assets, and abandon long-term plans at the worst possible moments. Volatility feels like danger, even when it is normal. Losses feel personal, even when they are temporary. Chapter 1 introduces the concept of emotional decision-making masquerading as logic. When fear takes control, the brain convinces you that selling is being responsible. When greed takes over, it convinces you that risk is opportunity. In both cases, the brain feels confident, even when it is wrong. The book explains how investors consistently sell after losses to avoid emotional pain, buy after gains to avoid missing out, overtrade to feel in control. Ignore long-term strategy in favor of short-term comfort. These behaviors are not accidents. They are predictable psychological patterns. A key idea introduced in this chapter is that the brain hates uncertainty more than loss. This is why investors often prefer a bad decision that feels certain over a good decision that feels uncomfortable. The brain values emotional relief today over financial growth tomorrow. Chapter 1 also challenges a dangerous myth that successful investing is about predicting the market. Instead, the book argues that successful investing is about managing your reactions to the market. The biggest gains come not from smarter forecasts, but from emotional discipline, staying calm when others panic, and staying patient when others chase. The chapter closes with a powerful shift in perspective. If you want to improve your financial outcomes, you must first understand how your brain works against you. Until you recognize these internal forces, no strategy, no matter how perfect, will save you from yourself. This is the foundation of the book's message. Master your mind, or it will master your money. You rarely experience the market as it truly is. You experience a version filtered, distorted, and emotionally amplified by your own brain. The book explains that the brain does not treat money as numbers. It treats money as survival. A loss on a screen triggers the same neural circuits as physical danger. Heart rate increases. Stress hormones rise. Logical thinking shuts down. In that moment, your brain is no longer trying to grow wealth. It is trying to escape pain. This is why investors often make decisions they later cannot explain. The chapter introduces loss aversion, one of the most powerful psychological forces in investing. The pain of losing is felt far more intensely than the pleasure of gaining. Because of this, investors hold losing investments too long, hoping to get back to even, sell winning investments too early to lock in gains, avoid necessary risk, even when the odds are in their favor. The brain would rather avoid emotional pain than maximize long-term outcomes. This single bias quietly destroys compounding. Chapter 1 then exposes another trap: overconfidence. When things go well, the brain rewrites history. A success is credited to skill, intelligence, and insight, while luck is ignored. This false confidence leads investors to take larger risks, trade more frequently, and abandon discipline just before reality corrects them. The book makes it clear: confidence feels good, accuracy does not, and the brain always chooses what feels good. Another powerful insight in this chapter is how the brain creates stories to justify decisions. Instead of admitting fear or greed, the brain invents reasons. The fundamentals have changed. This time is different. Everyone sees this opportunity. These stories feel rational, but they are emotional cover-ups. The brain hates admitting uncertainty, so it replaces doubt with narrative. Chapter 1 also introduces the idea of mental accounting, the tendency to treat money differently depending on its source or recent performance. Gains feel disposable. Losses feel sacred. This leads to inconsistent risk-taking and irrational portfolio decisions that have nothing to do with logic or strategy. Chapter 2, Inside the Investor's Brain, the Power of Mind, over money fear, greed, and the illusion of control. Chapter 2 of Inside the Investor's Brain, the Power of Mind over Money, exposes the two emotions that quietly dominate nearly every financial decision: fear and greed. The book makes a bold claim. Most investors believe they act rationally, but in reality, they are constantly reacting to emotional pressure they barely notice. Fear appears first. The chapter explains that fear is not triggered by loss itself, but by uncertainty. When prices move unpredictably, the brain demands clarity. It wants answers. It wants certainty. When it cannot get them, it creates urgency. That urgency feels like wisdom, but it is panic in disguise. This is why investors sell at the bottom, not because they are stupid, but because the brain convinces them that doing something is safer than doing nothing. Action feels like control, even when it destroys value. Greed works differently, but it is just as dangerous. Greed is not the desire for money. It is the fear of being left behind. Chapter 2 explains how the brain interprets other people's success as a threat. When everyone else appears to be winning, the brain experiences anxiety and not inspiration. This leads to chasing rising assets, ignoring risk, and entering markets at exactly the wrong time. The book introduces the illusion of control, the belief that more information, more activity, and more complexity lead to better outcomes. In truth, excessive trading often reduces returns. The brain mistakes effort for effectiveness. A powerful section of this chapter shows how investors confuse movement with progress. Checking prices constantly, reacting to news, and adjusting portfolios feels productive. But the book reveals that the most successful investors often do less, not more. They create systems that protect them from their own impulses. Chapter 2 also explores how the brain exaggerates recent events. A market crash feels permanent. A winning streak feels endless. This is called recency bias, and it explains why investors are always preparing for what just happened, rather than what is likely to happen next. One of the chapter's strongest insights is this: the brain would rather be wrong with the crowd than right alone. This explains herd behavior, bubbles, and crashes. Social proof feels safe. Standing apart feels dangerous, even when the data supports it. As Chapter 2 concludes, the book reframes discipline. Discipline is not willpower. It is not strength. It is structure. Systems, rules, and pre-committed decisions remove emotion from the moment when emotion is most powerful. The chapter ends with a hard truth. You will never eliminate fear or greed. They are part of being human. But you can design your investing life so that these emotions lose their authority. Because in the market, the most dangerous illusion is not risk. It is the belief that you are in control when your emotions are holding the wheel. Why doing nothing feels harder than doing the right thing. As inside the investor's brain, the power of mind. Over Money pushes deeper into Chapter 2. The book reveals one of the most damaging investor instincts, the inability to sit still. The brain equates inaction with danger. When markets are volatile, doing nothing feels irresponsible even when it is the correct decision. This is why investors overtrade, overreact, and constantly adjust their strategy. The brain craves relief, not results. The chapter explains action bias, the tendency to prefer action over patience. In uncertain environments, action creates the illusion of safety. Selling feels like protection. Buying feels like opportunity. Waiting feels like exposure. The brain would rather make a mistake than tolerate discomfort. This is why the most destructive decisions often feel urgent. Chapter 2 also explores how information overload intensifies emotional mistakes. More news does not create clarity. It creates noise. The brain is not built to process constant updates, predictions, and opinions. Each new piece of information triggers emotional reactions, pulling investors further away from long-term thinking. The book makes a sharp distinction between information and signal. Most investors drown in data, but starve for wisdom. The brain reacts to headlines, not probabilities. It responds to stories, not statistics. Another critical insight in this chapter is how fear and greed reinforce each other. After fear forces an investor out of the market, greed later pulls them back in, usually at higher prices. This emotional cycle repeats endlessly, quietly, transferring wealth from reactive investors to disciplined ones. The chapter highlights that markets reward those who can tolerate boredom, uncertainty, and social discomfort. These traits feel passive, but they require strength. Patience is not weakness. It is psychological endurance. A powerful section of Chapter 2 explains that volatility is not the enemy of wealth. Reaction to volatility is. Price movement is normal. Emotional response is optional. The difference between average investors and exceptional ones is not intelligence, it is restraint. The chapter closes with a sobering reminder. Every time you act on emotion, you train your brain to do it again. Repetition turns reaction into habit. Habit turns into identity. And identity determines financial destiny. By the end of Chapter 2, the book leaves you with a challenge. If you cannot control your need to act, you will never control your outcomes. The market does not demand constant decisions. Your brain does. And until you learn to ignore that voice, fear and greed will continue to quietly dictate your financial life. Chapter 3, Inside the Investor's Brain. The power of mind over money, wiring, bias, and the hidden enemies of rational investing. Chapter 3 of Inside the Investor's Brain. The power of mind over money shifts the focus from emotions you can feel to forces you cannot see. It reveals that even when investors believe they are calm, logical, and disciplined, their decisions are still being shaped by deep cognitive biases built into the brain. The book explains that the brain is not designed to find truth. It is designed to conserve energy. To do this, it relies on shortcuts. These shortcuts feel efficient, but in investing, they are expensive. One of the first biases explored is confirmation bias. Once the brain forms an opinion about an investment, it actively searches for information that supports it and ignores anything that challenges it. Investors do not want accuracy, they want reassurance. This leads to holding bad positions longer than they should and dismissing warning signs as noise. Next, the chapter examines anchoring. The brain fixates on a specific number, often a purchase price, past high, or analyst prediction, and treats it as meaningful, even when it has no relevance to current reality. Investors wait for prices to come back, not because it is rational, but because the brain refuses to let go of a reference point. The book then addresses availability bias, the tendency to overestimate the importance of information that is recent, vivid, or emotionally charged. Dramatic news feels significant. Quiet data feels boring. The brain mistakes emotional intensity for probability, leading investors to misjudge risk and opportunity. Chapter 3 makes a critical point. Biases do not disappear with experience. In many cases, experience makes them worse, because confidence grows faster than accuracy. A powerful section of this chapter explains how the brain protects the ego. Admitting a mistake feels like a threat to identity. So the brain reframes losses as temporary, blames external forces, or doubles down to avoid psychological discomfort. This is how small errors become catastrophic ones. The book also explores self-attribution bias, taking credit for wins and avoiding responsibility for losses. Over time, this distorts self-assessment and leads investors to believe they are more skilled than they actually are. The market eventually corrects this illusion. As the chapter progresses, the book emphasizes that awareness alone is not enough. Knowing about biases does not neutralize them. Investors must design decision-making systems that operate even when the brain is under stress. The chapter closes with a sobering truth. Your brain is not broken. It is doing exactly what it evolved to do. The problem is not the brain. It is asking it to operate in an environment it was never built for. Chapter 3 leaves you with a clear message. If you want better results, you must stop trusting your instincts and start managing them. Because in investing, the greatest risks are not visible on a chart. They live inside your head. Why? Knowing better still isn't enough. As inside the investor's brain, the power of mind over money continues. Through Chapter 3, the book delivers an uncomfortable insight. Most investors already know what they should do, yet still fail to do it. The problem is not ignorance, it is mental interference. The chapter explains that cognitive biases operate automatically. They do not ask permission. By the time you notice them, they have often already influenced your decision. This is why simply reading about psychology does not make you immune to it. The brain is not persuaded by knowledge. It is driven by emotion, habit, and identity. One of the most damaging patterns explored here is belief persistence. Once the brain commits to a belief, it resists updating it, even when faced with contradictory evidence. Investors cling to outdated views because changing one's mind feels like admitting weakness. The brain treats belief change as loss. The book then examines hindsight bias, the illusion that outcomes were obvious after they happen. This false clarity gives investors confidence in their ability to predict the future, even when their past decisions were driven by luck. Over time, this creates a dangerous cycle of misplaced certainty. Another key concept introduced is narrative fallacy. The brain loves clean explanations. It turns random outcomes into meaningful stories. Markets move, and the brain immediately asks, why? Even when no clear reason exists. These stories feel satisfying, but they mislead decision-making by replacing probability with fiction. Chapter 3 also addresses how stress changes the brain itself. Under pressure, the brain shifts control away from rational thought and toward emotional reaction. Long-term planning weakens. Short-term relief dominates. This is why even disciplined investors break their own rules during extreme market events. A powerful insight from this chapter is that willpower is unreliable. Discipline based on self-control eventually fails because emotions grow stronger under stress. The book argues that the only sustainable solution is environment design, rules, automation, and constraints that prevent bad decisions before they occur. The chapter emphasizes that professionals do not rely on gut feeling. They rely on process. They separate decision-making from outcome. They judge decisions based on logic, not results. This protects them from emotional overreaction and identity-driven mistakes. Chapter 3 concludes with a decisive shift in mindset. You are not here to be right. You are here to be consistent. Consistency compounds. Emotion does not. By the end of this chapter, the book makes one thing clear. If you trust your instincts in an environment designed to exploit them, you will continue to repeat the same mistakes, no matter how much you learn. Mastery begins when you stop listening to every thought your brain produces and start choosing which ones deserve action. Wiring, bias, and the hidden enemies of rational investing. Chapter 3 of Inside the Investor's Brain, The Power of Mind Over Money, digs deeper into the internal forces that quietly sabotage investors, even when they think they are making rational decisions. The book emphasizes a harsh reality. Your brain is not designed for investing, and intelligence alone cannot protect you. The chapter begins by explaining that the brain relies on mental shortcuts, automatic rules of thumb that save energy but distort judgment. These shortcuts, or biases, operate without conscious awareness, quietly steering decisions toward mistakes. Key biases explored include confirmation bias. Once your brain forms an opinion, it actively seeks information that supports it and ignores anything contradictory. Investors cling to investments that feel right, even when evidence says otherwise. Anchoring. The brain fixates on reference points like the price you bought a stock at or the recent market high. This distorts judgment and causes you to hold losing investments or chase gains that are no longer rational. Availability bias. The brain overestimates the importance of recent or emotionally charged events. Dramatic market news feels critical, while quieter signals are ignored, causing misjudged risk and opportunity. Overconfidence and self-attribution bias. Investors take credit for successes and blame external factors for failures. This inflates confidence, encourages excessive risk-taking, and reinforces repeated mistakes. The chapter makes an important point. Experience alone does not reduce biases. Sometimes it amplifies them. Confidence grows faster than true skill, creating a dangerous illusion of control. Chapter 3 also explores narrative fallacy, where the brain constructs stories to explain random events. While these stories feel logical, they are often misleading, replacing probabilities with fiction. Markets are interpreted through these mental narratives rather than cold analysis, leading to predictable mistakes. The book stresses that even knowing about these biases is insufficient. Awareness does not neutralize them. The brain will act on ingrained patterns, especially under stress. The chapter emphasizes that the most successful investors design systems and rules that prevent emotion-driven mistakes rather than relying on willpower alone. Finally, Chapter 3 delivers a key insight. You are not in the market to be right. You are in it to be consistent. By the end of this chapter, the reader understands that the real battle is internal. Markets are not the enemy. Your own brain, operating on survival instincts and cognitive shortcuts, is. Mastery begins when you stop trusting every thought your brain produces and start controlling which thoughts guide action. Chapter 4. Inside the investor's brain, the power of mind over money, building mental discipline in an emotion-driven market. Chapter 4 marks a turning point in the book. After exposing how the brain sabotages financial decisions, inside the investor's brain, the power of mind over money now focuses on the solution, discipline, not as willpower, but as structure. The chapter opens with a hard truth. Willpower is unreliable. Under stress, fatigue, or uncertainty, willpower collapses. The brain seeks relief, not long-term benefit. This is why even disciplined investors break their own rules during volatile periods. The book argues that real discipline is not internal strength. It is external design. Successful investors do not rely on moment-by-moment judgment. They rely on pre-committed rules made when emotions are calm. These rules act as guardrails, preventing impulsive decisions when fear or greed spikes. Chapter 4 introduces the idea of decision separation, the practice of separating planning from execution. Planning happens slowly, rationally, and deliberately. Execution happens automatically, with minimal emotional input. This separation protects investors from reacting to noise. The book explains how routines, checklists, and constraints reduce cognitive load. When decisions are simplified, the brain has fewer opportunities to interfere. Complexity invites emotion. Simplicity enforces consistency. A major insight in this chapter is that emotion is not the enemy. Timing is. Emotions are inevitable, but they become destructive when they are allowed to dictate actions in real time. By delaying decisions, by forcing pauses, investors regain control. Time weakens emotional intensity and restores perspective. Chapter 4 also emphasizes the importance of long-term framing. Short-term price movements feel important because the brain magnifies immediacy. Successful investors train themselves to think in years, not days. This shift reduces stress and improves decision quality, not because the market changes, but because perception does. Another powerful section discusses rule-based investing. Rules remove identity from outcomes. A loss becomes a data point, not a personal failure. This emotional detachment allows investors to stay consistent even when results are temporarily disappointing. The chapter challenges a common misconception that discipline restricts freedom. In reality, discipline creates freedom. Freedom from panic, from constant monitoring, from emotional exhaustion. Structure replaces stress with clarity. Chapter 4 closes with a defining message. You don't rise to the level of your intelligence, you fall to the level of your systems. By the end of this chapter, the reader understands that mastering money begins with mastering process. When decisions are automated, simplified, and protected from emotion, the brain loses its ability to sabotage outcomes. The market will always be uncertain. Your emotions will always exist. But with the right systems, they no longer control your future. Chapter 5. Inside the investor's brain, the power of mind. Over money, patience, time, and the advantage of emotional endurance. Chapter 5 reveals a truth most investors never fully accept. Time rewards patience, but only for those who can emotionally survive it. The book explains that compounding is not just a mathematical force. It is a psychological test. Wealth grows slowly, unevenly, and often invisibly. The brain hates this. It wants feedback now. It wants progress. It can feel. When results don't arrive quickly, doubt fills the gap. This is why many investors quit strategies that would have worked right before they start working. Chapter 5 introduces the idea of emotional endurance, the ability to remain committed during long periods of boredom, uncertainty, and underperformance. This skill matters more than timing, prediction, or intelligence. The market does not pay for brilliance, it pays for staying power. The book explains that the brain constantly compares the present to imagined alternatives. I could have done better. I should have sold earlier. These thoughts create regret, which leads to strategy hopping. Every switch feels like improvement, but most are just reactions to discomfort. A powerful insight in this chapter is that most investment pain comes from comparison, not loss. Watching others appear to win faster triggers impatience and self-doubt. The brain interprets someone else's success as evidence that you are failing, even when your plan is sound. Chapter 5 also dismantles the myth of perfect timing. Waiting for the right moment feels prudent, but it is often fear disguised as discipline. The book argues that consistent participation beats perfect entry because markets reward exposure over prediction. Another key idea introduced here is delayed gratification under uncertainty. Unlike traditional rewards, investing offers no guaranteed payoff. You act today with no promise of reward tomorrow. This uncertainty makes patience feel risky, but it is the price of compounding. The chapter emphasizes that volatility is not a flaw in the system. It is the cost of admission. Without volatility, there would be no premium for patience. Emotional discomfort is the fee paid by those who want long-term growth. As Chapter 5 closes, the book delivers one of its most defining lessons. Time does not create wealth. Staying invested through discomfort does. Those who win are not the ones who avoid fear, but the ones who refuse to obey it. By the end of this chapter, the reader understands that patience is not passive. It is an active, daily decision to endure uncertainty without surrendering control. And in investing, the ability to wait is often the most profitable skill of all. Chapter 6, Inside the Investor's Brain, the Power of Mind, over money, stress, pressure, and decision-making. Under Fire, Chapter 6, confronts the moment when everything breaks down. Stress. The book explains that stress doesn't just influence decisions, it changes how the brain works. Under pressure, the brain shifts control away from long-term reasoning and hands it to emotional survival systems. Planning shrinks, perspective collapses, the present moment feels overwhelming. This is why investors abandon sound strategies during market turmoil, not because the strategy stopped working, but because their brain stopped cooperating. The chapter reveals a critical insight. Stress narrows time horizons. When uncertainty rises, the brain focuses on immediate relief. Long-term goals feel distant and irrelevant. Selling reduces anxiety now, even if it damages outcomes later. The brain chooses comfort over compounding. Chapter 6 also explains why volatility feels exhausting. Constant price movement keeps the brain in a heightened alert state. Over time, this leads to decision fatigue. As mental energy drains, discipline weakens. Investors begin making impulsive choices simply to escape the pressure of uncertainty. A powerful section explores stress-induced certainty. When the brain feels overwhelmed, it becomes attracted to absolute answers, strong opinions, confident forecasts, bold predictions. Certainty feels calming even when it's false. This is why extreme views become popular during market chaos. The book emphasizes that stress does not make you irrational. It makes you human. But unmanaged stress repeatedly leads to the same predictable mistakes. Abandoning long-term plans at the worst moments, overreacting to short-term news, seeking safety and consensus rather than logic. Chapter 6 introduces a crucial practice: reducing exposure to emotional triggers, fewer price checks, less news consumption, clear boundaries between investing decisions and daily life. The book argues that controlling inputs is just as important as controlling actions. Another key insight is that calm is not confidence. Calm is a skill. It is built through preparation, not prediction. Investors who appear calm during crises are not fearless. They are protected by systems that limit emotional interference. The chapter closes with a defining principle. You don't make your best decisions when you feel safe. You make them when safety is unnecessary. By the end of Chapter 6, the reader understands that mastering money requires mastering stress, not eliminating it, but preventing it from hijacking decisions. Because the market will always apply pressure, the question is whether your mind is trained to withstand it. Chapter 7, Inside the Investor's Brain, the Power of Mind, over money identity, ego, and the need to be. Right, Chapter 7 exposes one of the most dangerous forces in investing, identity. The book explains that money decisions are rarely just financial. They are personal. Over time, investors begin to attach their self-worth to their opinions, their strategies, and their past decisions. When an investment works, it feels like validation. When it fails, it feels like an attack. This is where ego quietly takes control. The chapter reveals that the brain does not merely want profits. It wants to be right. Being right protects identity. Being wrong threatens it. And once ego enters the equation, rational decision-making weakens. Investors begin defending positions instead of evaluating them. They explain losses instead of correcting mistakes. They double down, not because the data supports it, but because admitting error feels unbearable. Chapter 7 highlights a brutal truth. The market does not reward intelligence. It rewards humility. The book explores how identity-driven investing leads to rigidity. When investors label themselves long-term, contrarian, value-focused, aggressive, they begin protecting the label instead of adapting to reality. The strategy becomes who they are, not what they do. A powerful section explains why changing your mind feels painful. The brain treats belief revision as loss. Letting go of an opinion feels like giving up ground, even when it improves outcomes. This is why investors stay trapped in failing ideas long after evidence demands change. The chapter also examines public commitment. When investors share opinions publicly, ego pressure increases. Reversing course now risks embarrassment. As a result, bad decisions are maintained longer, and losses deepen, not because of logic, but because of pride. Another key insight in this chapter is the danger of emotional ownership. The more effort, research, and time invested into an idea, the harder it becomes to abandon it. The brain confuses effort with value. Walking away feels like wasting energy, even when staying costs more. Chapter 7 introduces a critical reframe. You are not your portfolio. Losses are not failures. Mistakes are not character flaws. The most successful investors separate identity from outcome. They allow ideas to fail without allowing ego to intervene. They treat decisions as experiments, not declarations. The chapter closes with a powerful reminder. You don't get paid for being right. You get paid for being adaptive. By the end of Chapter 7, the reader understands that the moment ego takes over, learning stops. And when learning stops, losses accelerate. In investing, strength is not stubbornness. It is the courage to change your mind, quietly, quickly, and without apology. Chapter 8, Inside the Investor's Brain, The Power of Mind, Over Money, Building a Brain that Works with the Market, Not Against It. Chapter 8 brings everything together. After exposing fear, bias, stress, and ego, the book now answers the most important question. How do you actually rewire your behavior in a market designed to exploit your mind? The chapter begins with a clear statement. You do not win by eliminating emotion. You win by designing around it. The book explains that the goal is not to become emotionless, but to become emotionally irrelevant to your own decisions. Feelings can exist, but they must lose voting power. Chapter 8 introduces the idea of process over outcome. Most investors judge themselves by results. The problem is that outcomes are noisy and often driven by randomness. When investors tie confidence to short-term results, emotions swing wildly. The book argues that mastery comes from judging decisions by process quality, not by whether they immediately worked. Another major concept is pre-commitment. Decisions made in advance, rules for buying, selling, rebalancing, and risk, protect investors from their future emotional states. You don't trust your future self under stress. You protect yourself from it. The chapter emphasizes simplicity as a psychological advantage. Complex strategies invite overthinking, doubt, and emotional interference. Simple systems reduce decision points, which reduces the brain's ability to sabotage execution. The fewer choices you have in the moment, the fewer mistakes you make. Chapter 8 also focuses on environment control. The brain reacts to what it sees repeatedly. Constant news, price alerts, opinions, and predictions keep emotions activated. The book argues that successful investors aggressively filter inputs. Less information often leads to better decisions, not because ignorance is power, but because noise is poison. A powerful insight in this chapter is the role of time distance. When investors mentally zoom out, thinking in years instead of days, emotions weaken, urgency fades, perspective returns. The market feels less threatening not because risk disappears, but because meaning changes. Chapter 9, Inside the Investor's Brain, The Power of Mind Over Money. The Final Edge, Mastering Yourself for a Lifetime of Better Decisions. Chapter 9 serves as the culmination of the book's message. After exploring fear, bias, stress, ego, and discipline, the book delivers its final conclusion. The ultimate advantage in investing is not strategy. It is self-mastery sustained over time. The chapter opens with a sobering realization. There is no finish line. Markets evolve, conditions change, new risks appear. The investor's task is not to find a perfect system once, but to remain psychologically adaptable for decades. The book emphasizes that most investors fail not because of a single catastrophic mistake, but because of small, repeated lapses in behavior. Minor emotional decisions repeated over years quietly compound into major underperformance. Success works the same way. Small acts of discipline, repeated consistently, create extraordinary outcomes. Chapter 9 reframes mistakes. Errors are not signs of incompetence. They are feedback. The most successful investors are not those who avoid mistakes, but those who recover quickly and adjust without ego. Reflection replaces regret. Learning replaces blame. A key insight in this chapter is the importance of identity design. Instead of identifying as someone who beats the market, the book encourages identifying as someone who follows rules even when it's uncomfortable, thinks in decades, not months, accepts uncertainty without panic, values consistency over excitement. This identity shapes behavior automatically. When identity is aligned with discipline, good decisions require less effort. The chapter also discusses financial peace, the emotional outcome of mastering your mind. Investors who control their behavior experience less anxiety, fewer emotional swings, and greater clarity. Wealth becomes a tool, not a source of constant stress. Chapter 9 warns against the endless search for the next insight, the next strategy, the next shortcut. The book argues that most breakthroughs do not come from learning something new, but from finally applying what you already know, consistently and without interruption. As the book closes, it delivers its final defining message. The market is a test you take every day, not of intelligence, but of temperament. Those who pass are not the loudest, fastest, or most confident. They are the calmest, the most patient, the most self-aware. By the end of Chapter 9, the reader understands that investing mastery is not about controlling markets. It is about controlling reactions. Day after day, year after year, when you master your mind, money stops controlling you. And that is the real power of mind over money. Chapter 10, Inside the Investor's Brain, The Power of Mind Over Money, The Quiet Victory, Living Beyond the Market. Chapter 10 is not about markets anymore. It's about what happens after you master your behavior. The book makes a powerful shift here. Once you stop fighting your own brain, investing fades into the background of life, exactly where it belongs. The goal was never obsession, constant monitoring, or emotional highs and lows. The goal was freedom from mental noise. This chapter explains that the greatest reward of psychological mastery is not higher returns alone, but clarity. When decisions are guided by process instead of emotion, mental energy is released, anxiety decreases, confidence stabilizes, money stops dominating attention. The book emphasizes a critical truth. Most people don't actually want to beat the market. They want peace. Peace comes from knowing you will not sabotage yourself in moments of fear. Peace comes from trusting your system when uncertainty appears. Peace comes from understanding that volatility is no longer a personal threat. Chapter 10 discusses how investors who master their behavior begin to think differently about time. They stop measuring progress in weeks or months and start measuring life in seasons and decades. This long view weakens urgency and dissolves panic. The future no longer feels fragile. Another major idea in this chapter is detachment from outcomes. Results still matter, but they no longer control mood, identity, or self-worth. Wins don't inflate ego, losses don't crush confidence. The investor becomes emotionally stable in an unstable environment. The book explains that this stability creates a rare advantage, the ability to stay invested while others quit. When fear dominates the crowd, the calm investor quietly continues. This is not excitement. It is endurance. Chapter 10 also reframes success. Success is not constant growth. It is resilience. It is staying aligned with principles even when results are temporarily disappointing. It is resisting the urge to react when reaction feels justified. As the book approaches its final message, it delivers one last reminder. The market will test you endlessly, but it can only defeat you if you participate emotionally. The investor who wins is not the one who predicts the future, but the one who survives it without self-destruction. The chapter ends with a quiet but powerful conclusion. You don't conquer the market. You don't outsmart it. You outgrow it. When your mind is disciplined, money becomes a tool, not a trigger. And when money stops controlling your emotions, you gain something far more valuable than returns: control over your life. Chapter 11. Inside the investor's brain, the power of mind over money. The investor you become when no one is watching. Chapter 11 delivers the book's final psychological layer, the part most investors never think about, but which ultimately decides everything: who you are when there is no pressure, no noise, and no audience. The book explains that true mastery is revealed in silence, not during crashes, not during rallies, but during ordinary days when nothing dramatic is happening. This is where most investors slowly drift off course. Without fear to wake them up or excitement to motivate them, discipline quietly erodes. Rules feel optional. Attention fades. Small compromises begin, and over time, these small compromises undo years of progress. Chapter 11 emphasizes a powerful truth. Your future is shaped more by what you do consistently than by what you do intensely. The book explains that successful investors build default behaviors. They don't rely on motivation. They rely on routine. When investing becomes boring, repetitive, and almost invisible, that's when it's working. This chapter introduces the idea of behavioral identity locking. Instead of asking, "What should I do now?" elite investors ask, What does someone like me do in situations like this? Identity drives action automatically. The book shows how investors who internalize discipline no longer debate decisions emotionally, they execute calmly because their behavior is aligned with who they believe they are. The market no longer negotiates with them. Chapter 11 also explores long-term integrity, staying consistent even when shortcuts appear tempting. Chasing trends, copying others, bending rules slightly, these feel harmless in isolation. But the book warns that integrity erosion always starts small and ends expensive. Another key insight is that wealth is built quietly but lost loudly. Most failures don't happen during dramatic moments. They happen through gradual neglect. The investor stops paying attention to process not because they are reckless, but because they feel safe. The chapter reinforces that psychological mastery is never finished. There is no permanent graduation. There is only maintenance. The mind must be managed continuously, just like capital. As chapter 11 closes, the book delivers one of its most sobering messages. The market doesn't care how disciplined you were yesterday. It only responds to what you do today. By the end of this chapter, the reader understands that the final edge is not intelligence, experience, or strategy. It is character. The ability to remain consistent when no one is forcing you to be. When discipline becomes identity, when process becomes habit, when patience becomes automatic, you are no longer reacting to the market. You are operating above it. Chapter 12, The Legacy of Behavioral Wealth. Chapter 12 delivers an most mature realization. Wealth is not just something you accumulate, it is something you pass on through behavior. The book explains that money itself is neutral. What truly transfers across generations, careers, and life stages is how you think, decide, and react under uncertainty. Most people inherit assets without inheriting discipline, and that is why wealth so often disappears. This chapter introduces the concept of behavioral legacy. Your greatest financial contribution is not a portfolio, it is a mindset. The habits you build, the calm you demonstrate during chaos, and the restraint you practice when temptation appears become a blueprint others unconsciously follow. The book emphasizes that children, partners, colleagues, and peers learn far more from how you behave than from what you explain. Panic teaches panic. Patience teaches patience. Consistency teaches confidence. A powerful insight in this chapter is that financial wisdom compounds socially. One disciplined decision influences another. One calm reaction prevents another mistake. Over time, emotional stability creates an environment where better decisions become normal, not exceptional. Chapter 12 also reframes success one final time. True success is not maximum returns. It is sustainable behavior. A system that works only when conditions are perfect is fragile. A mindset that works during stress, boredom, and uncertainty is durable. The book explains that the ultimate investor advantage is becoming someone who is not impressed by noise, is not shaken by volatility, is not seduced by shortcuts, is not defined by outcomes. This person does not dominate conversations. They do not predict loudly. They do not chase validation. They quietly execute. Another critical idea in this chapter is detachment with responsibility, caring deeply about process while remaining emotionally neutral about outcomes. This balance prevents both recklessness and fear. It allows long-term thinking in a short-term world. As the book reaches its final message, it leaves the reader with this defining truth. Money reflects behavior. Behavior reflects identity. Identity determines destiny. By the end of Chapter 12, the reader understands that mastering the investor's brain is not about markets at all. It is about becoming the kind of person who makes good decisions repeatedly across money, time, and life. When you control your reactions, you control your direction. And when your direction is steady, wealth, financial and psychological, inevitably follows. Chapter 13. Inside the Investor's Brain. The Power of Mind Over Money. The Final Discipline. Staying Human in an Unforgiving System. Chapter 13 delivers the book's closing discipline, the one that outlasts every strategy, every market cycle, and every phase of life. Staying human without letting humanity ruin decisions. The book makes a clear distinction here. Mastery does not mean becoming cold, robotic, or detached from life. It means understanding your emotional nature so deeply that it no longer controls your actions. The market is unforgiving, not because it is cruel, but because it is indifferent. It does not care how hard you tried, how much you hoped, or how confident you felt. This chapter explains that the final evolution of an investor is acceptance. Acceptance that uncertainty never disappears. Acceptance that discomfort is permanent. Acceptance that there is no final safe point. Once this acceptance occurs, resistance ends. And when resistance ends, clarity begins. The book introduces the idea of emotional neutrality with moral clarity. You still care. You still act responsibly, but you stop attaching emotional meaning to every fluctuation. Money becomes a tool again, not a scoreboard, not a judgment, not a source of identity. Chapter 13 emphasizes that the most dangerous phase of investing is not the beginning. It is late confidence, when systems have worked for a long time. Vigilance fades. Discipline softens. The brain whispers that control is no longer necessary. This is when the final test appears. The book warns. The market punishes arrogance quietly and then all at once. This chapter reinforces lifelong humility, not insecurity, not fear, but respect for randomness, for risk, and for your own limitations. Investors who survive for decades are not the smartest. They are the most realistic about themselves. Another powerful insight here is that peace is a competitive advantage. Calm investors see clearly. They act slowly. They avoid extremes. While others swing between fear and euphoria, the calm investor compounds quietly in the background. The chapter also addresses meaning beyond money. Wealth without psychological control creates anxiety, not freedom. But when behavior is mastered, money amplifies life instead of dominating it. Decisions improve not only in investing, but in time, relationships, and priorities. As Chapter 13 closes, the book delivers its final truth. You don't master markets. You master responses, and that mastery follows you everywhere. The investor who reaches this point no longer asks, "Am I winning right now?" They ask, "Am I behaving correctly, regardless of outcome?" When that answer is yes, consistently, the result becomes inevitable. This is the true power of mind over money, not domination, not prediction, alignment. And once alignment is achieved, the market loses its ability to control you forever. Chapter 14. Inside the Investor's Brain, the Power of Mind Over Money. The End of the Battle. Chapter 14 is the book's quiet ending, not a celebration, not a victory lap, but a release. This chapter explains that the final stage of mastery is not domination of emotion, but the end of internal conflict. The investor no longer argues with fear, no longer negotiates with greed, no longer tries to silence thoughts. They simply observe and proceed according to principle. The book makes a profound statement here. Most suffering in investing does not come from loss. It comes from resistance, from wanting the market to behave differently than it does. When resistance ends, stress dissolves. The chapter describes how experienced, disciplined investors stop framing outcomes as good or bad. They frame them as expected. Volatility becomes normal. Drawdowns become temporary. Uncertainty becomes familiar. And familiarity removes emotional charge. A key insight in Chapter 14 is that clarity replaces intensity. Early in the journey, investing feels dramatic. Wins feel euphoric. Losses feel crushing. At the end of the journey, everything feels quieter. Decisions are smaller. Reactions are slower. Confidence is stable, not excited. The book explains that this is not boredom. It is freedom. Another powerful idea introduced here is detachment without disengagement. The investor remains responsible, attentive, and thoughtful, but no longer emotionally entangled. Money is respected, not worshipped. Risk is acknowledged, not feared. The chapter emphasizes that the greatest transformation is invisible to others. There is no announcement, no signal, no proof. The investor simply behaves differently, consistently across time. The market still moves. Headlines still shout. Opinions still conflict. But internally, the noise is gone. As the book reaches its final words, it delivers its ultimate conclusion. When the mind is disciplined, money becomes boring. And when money becomes boring, life becomes rich. Chapter 14 closes the loop that began in Chapter 1. The battle was never against the market. It was never against risk. It was against the untrained mind reacting to an indifferent system. Once that battle ends, there is nothing left to fight, only to live. Chapter 15, nothing left to prove. Chapter 15 is the true ending, not of the book, but of the struggle. This chapter explains that the final stage of investing mastery is the disappearance of ego-driven urgency. There is no need to outperform anyone, no need to explain decisions, no need to validate intelligence through results. The investor reaches a point where money is no longer a scoreboard. The book states a quiet but powerful truth. The most dangerous desire in investing is the need to prove something, to prove you were right, to prove you are smart, to prove you didn't miss out. Once this desire fades, mistakes lose their power. Wins lose their intoxicating effect. Decisions return to what they were always meant to be: deliberate, boring, repeatable actions. Chapter 15 emphasizes that freedom comes when investing stops being emotional labor. The investor no longer checks constantly, reacts instantly, or imagines alternative pasts. Regret fades because comparison fades. Anxiety fades because control is no longer demanded. A key insight here is that detachment creates precision. When emotions are no longer involved, decisions become cleaner. Exits are easier, adjustments are faster. There is no internal debate, only alignment with process. The book also makes it clear that this state is not passive. It is alert, grounded, and deeply aware, but not reactive. The investor acts when rules require action and rests when they do not. Nothing more, nothing less. Another powerful idea in this final chapter is acceptance without surrender. Acceptance of uncertainty does not mean giving up control. It means controlling what is controllable and releasing everything else. This balance removes exhaustion from decision-making. As the chapter moves toward its final message, it offers this reminder: when nothing needs to be proven, everything improves. At this stage, money serves life instead of competing with it. Time feels abundant. Attention returns to what truly matters. Investing becomes a background system, reliable, quiet, and emotionally neutral. The book ends with its final sentence, simple and complete. You were never meant to conquer the market. You were meant to outgrow the version of yourself that fought it. And when that happens, wealth stops being stressful. Discipline becomes natural. And the mind finally rests. This is the end of the book and the beginning of real control. Chapter 16. Inside the Investor's Brain, the Power of Mind over Money. The Epilogue. The Mind that Compounds Forever. Chapter 16 is not an extension of strategy. It is a closing reflection on what remains when everything unnecessary has been stripped away. The book makes one final clarification. Investing was never the destination. It was the training ground. Markets did not exist to reward prediction. They existed to expose behavior. Every rise tested restraint. Every fall tested courage. Every period of boredom tested patience. Over time, the investor was shaped not by returns, but by repeated choices under uncertainty. This chapter explains that the mind you build through disciplined investing does not stay confined to money. It spills into every area of life. Decisions become calmer. Reactions become slower. Confidence becomes quieter. You stop needing outcomes to validate identity. The book emphasizes a lasting truth. The greatest return on investing is not financial. It is psychological independence. Independence from panic. Independence from comparison. Independence from urgency. This is the state where compounding becomes inevitable, not just in capital, but in character. Chapter 16 revisits the beginning of the journey. The investor once believed the market was the problem. Over time, they learned the market was the mirror. It reflected fear, impatience, ego, and hope. Until those traits were understood, disciplined, and finally released. The book explains that this is why the best investors are often the least visible. They are not loud. They are not dramatic. They do not chase attention or validation. They execute quietly, while others exhaust themselves emotionally. Another key insight in this epilogue is that maintenance never ends. Mastery is not a permanent achievement. It is a habit. The mind must be tended just like capital. Neglect invites drift. Attention restores alignment. The final lesson of the book is simple and uncompromising. Markets change. Systems adapt. But behavior decides everything. When behavior is aligned with patience, humility, and process, the outcome no longer feels uncertain. It feels inevitable. The book closes with its final thought. You don't win by being smarter than others. You win by being calmer than your past self. And when calm becomes your default, compounding never stops. Because nothing inside you is trying to interrupt it anymore. This is the end of the journey and the beginning of a mind that compounds forever. Chapter 17 exists for one reason, to ensure the lesson survives after the book ends. The book makes a final observation. Knowledge fades, but habits remain. Inspiration is temporary. Psychology is permanent. What determines your future is not what you understood while listening, but what you do when emotion returns. Because it will return. Fear will come back during the next drawdown. Greed will whisper during the next rally. Doubt will appear during the next period of silence. The difference now is not that these emotions disappear. It's that you recognize them without obeying them. This chapter reinforces the ultimate rule. You don't need to feel confident to act correctly. You need a process that works when confidence is gone. The book reminds you that mastery is not dramatic. There is no moment where everything clicks forever. Mastery shows up quietly. When you don't check prices, when you don't react, when you don't explain yourself, when you don't panic. Chapter 17 reframes success one final time. Success is waking up years from now and realizing you were never pulled off course, that you stayed boring, that you stayed disciplined, that you stayed aligned while others burned energy, fighting noise. The book leaves you with a simple test you will face repeatedly. When uncertainty appears, do you react or do you execute? When outcomes disappoint, do you explain or do you continue? When others rush, do you follow or do you wait? These moments will never announce themselves as important. They will feel ordinary. That is why they matter. The chapter ends with the book's final sentence, meant to stay with you long after the audio stops. You were never searching for a better strategy. You were training for a better response. And once your response is trained, the market no longer controls your future. Your behavior does. This is not the end. It's simply where the excuses stop. Chapter 18 delivers the final psychological liberation, the point where money fully detaches from identity. The book explains that most people never stop using money as emotional proof. Proof of intelligence, proof of progress, proof of worth. Even after years of experience, they still let outcomes decide how they feel about themselves. This chapter ends that pattern. The investor described here no longer needs markets to confirm value. Wins do not inflate ego. Losses do not erode confidence. Results matter, but they do not define. This separation is the deepest form of control. The book makes a powerful distinction. There is a difference between caring and clinging. Caring leads to preparation, discipline, and responsibility. Clinging leads to fear, overreaction, and exhaustion. The mature investor still cares deeply, but without attachment. They show up, execute their system, and step back. The market becomes one part of life, not the center of it. Chapter 18 explains that this is when investing finally serves its real purpose, supporting a well-lived life instead of consuming it. Time opens up. Attention returns to health, relationships, learning, and meaning. Wealth becomes an enabler, not a mental burden. Another key insight in this chapter is that peace is earned, not given. It is earned by enduring uncertainty without collapsing into reaction, by letting boredom exist, by refusing to chase validation, by accepting that enough is enough. The book states plainly the goal was never to think about money all the time. The goal was to stop needing to. At this stage, the investor understands something few ever realize. The market is loud because people are loud inside. When the mind becomes quiet, the market loses its volume. Chapter 18 closes with a final reflection, not a command, not a lesson, but a recognition. You no longer look to money to tell you who you are. You already know. And when identity is settled, decisions become simple, discipline becomes natural, and wealth, quietly, steadily, does what it was always meant to do: support your life, not define it. This is the final freedom the book offers. As Chapter 18 continues, the book clarifies a crucial misunderstanding. Emotional detachment is not disengagement. Many investors fear that if they stop caring emotionally, they will become careless. The book rejects this completely. True detachment does not reduce responsibility. It improves it. When emotion steps back, judgment steps forward. The mature investor still reviews decisions, still respects risk, still prepares for uncertainty, but they no longer identify with outcomes. The chapter explains that attachment creates distortion. When money is tied to self-worth, every fluctuation feels personal. This leads to overreaction, interfering with systems that were designed to work over time. Detachment removes the urge to interfere. A key insight introduced here is selective attention. Advanced investors learn what deserves attention and what does not. Not every movement is meaningful. Not every headline matters. The brain no longer treats noise as signal. The book emphasizes that emotional neutrality restores proportionality. Small problems stay small. Temporary setbacks are not exaggerated into permanent threats. Perspective becomes stable, even when conditions are not. Chapter 18 also revisits the concept of enough. Most emotional damage in investing comes from undefined goals. When enough is unclear, the brain constantly pushes for more risk, more exposure, more urgency. This restlessness keeps investors emotionally trapped. Defining enough creates psychological closure. It limits greed. It stabilizes behavior. It allows the investor to protect what has already been built instead of endlessly chasing what might be next. Another powerful idea in this section is future self-respect. Mature investors don't ask, "How will I feel tomorrow?" They ask, "Will I respect this decision years from now?" This reframing weakens impulse and strengthens restraint. The chapter also highlights that emotional maturity changes how investors experience volatility. Volatility no longer feels like chaos. It feels like weather. Sometimes uncomfortable, sometimes inconvenient, but expected and survivable. As the chapter approaches its final reflection, the book delivers this reminder. Freedom is not having no risk. Freedom is not being ruled by it. The investor who reaches this stage no longer tries to optimize every outcome. They optimize behavior under uncertainty. And once behavior is stable, outcomes take care of themselves over time. Chapter 18 ultimately shows that this level of mastery is quiet, internal, and deeply personal. There is nothing to show off, nothing to explain, nothing to prove, just alignment. And when alignment is achieved, money finally becomes what it was always supposed to be, a background system, supporting a life that no longer revolves around it. When the brain stops fighting the market, as Chapter 18 deepens, the book exposes a final psychological shift that separates lifelong strugglers from mentally free investors. The end of internal conflict. Most investors are not fighting the market. They are fighting themselves. The brain wants certainty in a world built on probability. This mismatch creates constant tension, second-guessing, regret, anxiety, and the feeling that something must always be done. Chapter 18 explains that mastery begins when the investor accepts a hard truth. Uncertainty is not a flaw in the system. It is the system. Once this is accepted, the brain stops demanding guarantees that do not exist. Energy previously spent on emotional resistance is redirected toward preparation and discipline. The chapter introduces a powerful idea: pre-acceptance of loss. Great investors emotionally accept possible loss before it happens. This does not make them reckless. It makes them calm. Because when loss arrives, it is familiar, not shocking. The brain does not panic when it encounters what it has already rehearsed. This is why the book stresses decision-making before emotion, not during it. The investor designs rules in a neutral state, knowing that future emotions will try to override logic. Systems are not built to predict the future. They are built to protect the investor from themselves. Another major insight here is the danger of retrospective intelligence. After outcomes are known, the brain rewrites history, convincing itself that signals were obvious. This illusion fuels regret and overconfidence at the same time. Chapter 18 teaches that wisdom is judging decisions by process, not results. A good decision can lose money. A bad decision can make money. Emotionally immature investors reverse engineer beliefs from outcomes. Mature investors do not. The chapter then addresses identity separation. Money must never become proof of intelligence, worth, or competence. When identity is tied to results, every fluctuation becomes an attack on the self. Detachment restores psychological safety, allowing the investor to stay rational under pressure. As the chapter moves forward, it introduces the concept of mental bandwidth. Emotional volatility consumes cognitive resources. Calm investors think clearer, notice better opportunities, and avoid unnecessary risks. Not because they are smarter, but because their brains are not overloaded. One of the most important lessons in this section is that doing nothing is often the highest skill action. The brain confuses activity with control. Chapter 18 dismantles this illusion. Most long-term damage comes not from inaction, but from emotionally driven interference. The investor who has mastered this chapter understands something rare. Markets reward patience, but punish emotional urgency. Toward the closing stretch of Chapter 18, the tone becomes reflective. The book reminds us that financial success without psychological peace is incomplete. Wealth that requires constant emotional vigilance is not freedom. It is another form of labor. True success is quiet confidence, the ability to wait, the strength to ignore noise, the discipline to stay aligned with long-term intent. The chapter ends by reinforcing that money should amplify life, not dominate it. When the brain no longer obsesses over every move, time and attention return to where they belong: relationships, purpose, and growth beyond numbers. Chapter 18 is not about strategy, it is about release. Release from fear, release from compulsive control, release from the need to be right. And when that release happens, the investor finally steps into the highest form of mastery: calm participation in an uncertain world. Chapter 19 shifts the focus from decisions to identity. Not who you are today, but who repeated behavior slowly turns you into. The book opens this chapter with a quiet truth most investors never confront. Every financial decision is a vote for the kind of investor you are becoming. Short-term results feel loud. Long-term identity forms silently. This chapter explains that markets do not merely test skill, they shape character. Over time, repeated reactions to uncertainty hardwire habits into the brain. Panic becomes instinct. Patience becomes default. Discipline becomes automatic, or chaos does. The brain learns from repetition, not intention. That's why Chapter 19 emphasizes behavioral consistency over brilliance. You don't need to be exceptional once. You need to be reasonable thousands of times. The investor who survives long-term is rarely the smartest, but almost always the most stable. A key idea introduced here is self-reinforcing behavior loops. Good decisions create confidence. Confidence reduces emotional interference. Reduced interference improves future decisions. The same loop exists on the downside. Emotional decisions reinforce anxiety, which increases future emotional decisions. Over time, investors drift, not because of markets, but because of habits. The chapter warns that ego grows quietly during good times. When outcomes are favorable, the brain falsely credits skill instead of conditions. This creates overconfidence, position creep, and risk blindness. Chapter 19 reminds us that humility is not optional. It is protective. One powerful line from this section can be summarized as the market eventually punishes the personality it helped inflate. The book then explores time as the ultimate filter. Bad strategies can survive for a while. Poor discipline can appear successful temporarily. But time removes luck from the equation. What remains is behavior. This is why long-term investors focus on what they can control. Entry discipline, risk limits, emotional response, decision process. Not predictions, not narratives, not opinions. Another critical insight in Chapter 19 is that identity must be separated from outcomes. When your sense of self depends on results, you will subconsciously chase validation instead of alignment. You start trading to feel smart, not to be effective. The chapter encourages investors to adopt a different self-image. Not, I'm someone who's right, but I'm someone who survives. Survival compounds. Ego does not. As the chapter progresses, it introduces the idea of long-game thinking. Mature investors optimize for durability, not excitement. They choose strategies they can emotionally tolerate through decades, not strategies that look impressive in short bursts. The brain is asked one defining question: can you stay consistent when no one is watching and nothing is happening? That is where real identity forms. Toward the end of Chapter 19, the tone becomes almost philosophical. The book suggests that investing reveals who you are under uncertainty, but also gives you the chance to reshape yourself through discipline. Markets do not demand perfection, they demand persistence. And persistence is not willpower, it is identity alignment. The chapter closes by reminding the reader that wealth is not just accumulated capital, it is accumulated self-trust. Trust built from keeping promises to yourself, cycle after cycle, regardless of noise. Chapter 19 teaches this final principle. In the end, the most valuable asset you build is the investor you become. Chapter 20. Inside the Investor's Brain. The Power of Mind over Money Mastery as a Daily Habit. Chapter 20 concludes the book by focusing on the daily choices that compound into mastery. If Chapter 19 explored who you become over time, Chapter 20 explains how to make that identity inevitable. The book emphasizes that investing success is rarely the result of brilliance or insight. It is the sum of repeated small actions executed consistently day after day. Every check of your portfolio, every decision to stick to rules, every act of patience is a vote for the kind of investor you will become. Key lessons in this chapter include process over outcome. Results fluctuate. Systems endure. Judge yourself by the quality of your decisions, not the noise of short-term gains or losses. Rehearse before stress. Anticipate emotional moments before they happen. Decide in calm conditions how you will act during panic, greed, or boredom. Simplify to survive. Complexity invites emotional interference. Streamlined strategies reduce errors and preserve mental bandwidth. Detach without disengaging. Care deeply about rules and risk management, but do not tie your identity to outcomes. Emotional neutrality is the ultimate defense. Identity alignment. Ask not, what should I do? But who do I want to be? Your actions will follow your chosen identity automatically. The book makes a profound point. Mastery is not permanent, but habitual. It is not a trophy you earn once. It is a muscle you exercise every day. Neglect weakens it. Attention strengthens it. Chapter 20 also revisits the idea of long-term patience. True advantage comes not from the occasional brilliant trade, but from enduring and repeating correct behavior long after others have succumbed to emotion. The market rewards those who can tolerate discomfort longer than anyone else. Another critical insight is mental bandwidth preservation. The more you internalize rules, habits, and identity alignment, the less energy is wasted on reacting emotionally. Calm brains make better decisions, which compounds into long-term returns. The chapter closes by framing wealth as a byproduct of behavioral consistency. Money follows the mind, not the reverse. When behavior is disciplined, emotional interference minimized, and identity aligned with process, outcomes eventually reflect mastery. The final takeaway of Chapter 20 is simple yet powerful. Mastery is earned in the quiet moments. Discipline is compounded daily. The investor you become is the most valuable asset you will ever own. This chapter sets the stage for the epilogue, reinforcing that the market is a mirror, not an enemy, and that the ultimate edge lies within your own brain. Chapter 21. Inside the Investor's Brain, the Power of Mind Over Money. The Quiet Edge. Epilogue. Chapter 21 serves as the book's epilogue, not a summary of techniques, but a final reframing of what the real edge truly is. The chapter opens with a simple but unsettling idea. If everyone has access to the same information, the advantage cannot be information. Charts, data, news, analysis, these are commodities. What is rare is not knowledge, but emotional control under pressure. Chapter 21 makes it clear that the ultimate advantage in investing is invisible. It does not show up on a screen. It shows up in behavior when conditions are uncomfortable. The book explains that most investors lose not because they are wrong, but because they cannot sit with uncertainty. They confuse discomfort with danger. Action feels like safety. Stillness feels risky. And so they interfere with their own plans. The quiet edge is the ability to remain calm while others react. This chapter revisits all prior lessons through one lens: emotional endurance. Markets don't reward intelligence alone. They reward those who can endure boredom, fear, drawdowns, and doubt without abandoning discipline. A powerful concept introduced here is anti-fragile behavior. The best investors don't just survive volatility, they become more confident in their process because of it. Each cycle reinforces trust in systems rather than impulse. The chapter also dismantles the fantasy of arrival. There is no moment where investing becomes easy forever. Emotional challenges do not disappear. They change form. Early fear becomes later complacency. Early doubt becomes later overconfidence. Mastery is not the absence of emotion. It is non-obedience to emotion. Another key idea in Chapter 21 is life integration. Money is not the destination. It is a tool. When investing dominates emotional life, it has already failed its purpose. The most successful investors are often the least obsessed because they built systems that don't require constant attention. The book reminds us, if wealth costs peace, it is too expensive. As the epilogue continues, the tone becomes reflective and grounded. The author emphasizes that the market will continue to change, surprise, and challenge. Strategies will evolve, technologies will shift, narratives will rotate, But the human brain will remain the same. Fear will still whisper urgency. Greed will still disguise itself as opportunity. Ego will still demand validation. And that is why the edge remains permanent for those who master themselves. The final message of chapter 21 is not about outperforming others. It is about outlasting emotional mistakes, staying aligned when others drift, remaining disciplined when others chase, being patient when others panic. The book closes with this enduring truth. The market is not something you beat. It is something you learn to coexist with. And the investor who wins is the one who never lets the brain become the enemy. Chapter 21 leaves the reader with silence, not excitement, because silence is where discipline lives, and discipline, compounded over time, is the quiet force behind every lasting financial success. Chapter 22 explores what happens after years in the market when experience begins to override emotional reflexes. The book explains that time does not automatically make investors better, but time combined with reflection does. The brain slowly stops reacting and starts recognizing. Patterns that once caused panic now feel familiar. Volatility no longer feels personal, it feels repetitive. The investor realizes that most new fears are recycled versions of old ones. This recognition reduces urgency. Key takeaway of Chapter 22. Experience dulls emotional spikes. Familiar pain becomes manageable pain. Repetition trains emotional immunity. The chapter makes it clear that wisdom is not prediction. It is recognition without reaction. The seasoned investor is not fearless. They are simply no longer surprised. The chapter ends by emphasizing that the real reward of longevity in markets is not just capital, it is emotional resilience. Chapter 23 explains that ignoring investor psychology does not lead to neutral outcomes. It leads to systematic self-destruction. The book outlines how intelligent, well-informed investors still fail because they underestimate emotional influence. This chapter identifies the most expensive psychological errors: overtrading due to boredom, abandoning strategy after temporary losses, increasing risk to recover ego, mistaking confidence for competence. The core message is harsh but honest. Markets don't punish ignorance as brutally as they punish emotional denial. Chapter 23 reinforces that technical knowledge without psychological discipline is dangerous. The more tools an undisciplined investor has, the faster they can hurt themselves. The chapter closes by stating that most losses are not market-driven. They are self-inflicted, repeated quietly over time. Chapter 24, final chapter. Summary, the last advantage you'll ever need. Chapter 24 serves as the true final closure of the book. It distills everything into one enduring truth: the brain is the bottleneck. No matter how markets evolve, the limiting factor will always be human behavior. Technology may accelerate execution, information may become instant, but fear, greed, and ego remain unchanged. This chapter emphasizes emotional discipline outlasts strategy. Simplicity beats complexity over decades. Patience compounds invisibly. Survival precedes success. The book ends by reframing success. Winning is not about outperforming others. It is about avoiding the mistakes that destroy most investors. The final message of Chapter 24 is powerful and quiet. You don't need to be extraordinary. You need to be stable, and stability over time becomes unstoppable. This chapter closes the book not with excitement, but with clarity, because clarity is what allows discipline to endure when motivation fades. Chapter 23, Inside the Investor's Brain, the Power of Mind over Money, Why Smart Investors still lose. This chapter focuses on a core truth repeated throughout the book. Knowledge does not protect you from emotional mistakes. The author explains that most investors who fail are not uneducated. They understand markets, risk, and diversification. What destroys them is emotional override fear during losses, ego during wins, and impatience during flat periods. Key ideas that are directly aligned with the book. The brain is wired for survival, not probability. Emotional decisions feel logical in the moment. Overconfidence grows faster than discipline. Most damage is done during emotional peaks. The chapter reinforces that ignoring psychology does not result in average outcomes. It results in self-sabotage. The market doesn't beat you, your brain does. This is an accurate psychological conclusion of the book's later sections. Chapter 24. The author concludes that strategies change, markets evolve, information becomes free. But human behavior never changes. The book's final lesson is that long-term success belongs to investors who control reactions, not predictions, build systems that survive emotions, avoid catastrophic mistakes, stay consistent when others don't. The ultimate advantage is not intelligence, speed, or insight. It is behavioral stability over decades.